Hi everyone, welcome to Inderes TV. Today we're going to talk about Scanfil with Analyst Antti Viljakainen. Welcome.
Thank you.
They issued a profit warning right before the Q2, and now the Q2 is released. We knew there were going to be a drop in revenue, but what would you say? Was it expected? And summarize.
Well, the drop in revenue was a bit steeper than we expected. Sales declined in all three segments. On the segment level, energy and clean tech dropped a bit more than we expected, but the other segments were pretty much in line with our expectations. However, Scanfil managed to reduce variable costs relatively well in Q2 and actually made the EBIT that we expected them to do. So all the result lines were pretty much what we expected, so no surprises on the most important lines of the P&L statement.
Yeah. So we knew they were going to be sluggish, the figures, but what's the reason behind them?
The first and foremost reason is, of course, customer demand. That is not very strong at the moment. And because the demand is not strong, most of customers also reduce their inventories. Yeah. So Scanfil's revenue get like a double hit in this kind of situation when demand is decreasing and also inventory levels in different value chains are going down.
Yeah. This cost reductions and stuff, it's in the DNA of contract manufacturers. But would you say that Scanfil is particularly good in this area? I mean, keeping the EBIT at this level.
Well, it depends. Competition is tough, as you said. This is like a part of the name of the game in EMS business. But at least in Q2, Scanfil managed to do pretty well because revenue and EBIT dropped the same pace. Yeah. It's not easy to achieve this kind of results because there are always some fixed cost structure.
Yeah. So what about the guidance and the bigger picture going forward?
They of course retained the guidance they gave in the profit warning in June, but it's fair to assume that pretty weak demand environment will continue. Macroeconomics is struggling in Europe, which is the main market also for Scanfil. It's very difficult to know how much excess inventories customers actually have in their balance sheets, but the inventory reduction path began some year ago, and based on previous experience from different businesses, I would say that it usually takes more or less a year to reduce inventories when there are some build up happened. Yeah. So I would assume that the inventory reduction will continue to curtail demand in H2, but it should be more or less over for the next year. Okay. But it depends on macroeconomics, interest rates, inflation, how the investment-driven demand will actually improve from current levels. There are only weak signs of improving demand at this point, so it will take probably some time.
Okay, are there not any specific sector the investors should pay attention to there?
Well, Scanfil stated that the medtech and life science should improve first, and that's pretty natural because it's not that cyclical business as such. And then there is energy and clean tech segment, which is obviously getting support from green transition. So I would assume that it should recover the second because of this trend. But on the other hand, there might be the most of the excess inventories in these segments because it was booming last year. And then the industrial segment, it's very much driven by industrial demand
and the bigger picture.
Yeah, and it would require macroeconomics to improve, so that the demand in this segment could improve.
But we are talking about a year or so?
The next year should be better if US doesn't drop to recession. But the magnitude of the improvement is very difficult to explain.
True.
And there are no clear signs of improving demand yet. So
remains to be seen.
Yeah, we have to see signs first, and then the demand will improve.
Some words on valuation or recommendation.
Scanfil's valuation is pretty low, also based on the multiples of this year, which is like declining results. We are talking about single-digit EV/EBIT multiple.
Last time you said still cheap.
It's still cheap, and most likely will continue to be cheap until the profit growth trend.
Yeah. So what's our recommendation?
Will improve, but the valuation is that cheap that we will gladly continue to buy or accumulate Scanfil with this share price. If investors have a horizon of 2 to 3 years, it's a very good time to buy the stock and get a good annual return on the next upcycle.
Yes. Thank you so much for all these comments, Antti Viljakainen. Scanfil, still cheap. Read the report at inderes.se.